Greetings from Fin Study Club. My name is Ankur Kulshrestha, welcoming all viewers to the third session, which will cover inventory method changes, which is essentially the conversion of LIFO method into the FIFO method. Moving on to this inventory change, let us first understand whether such a change is allowed or not. Now, in your level 1, we have talked about that any change in accounting principle is allowed only when it leads to a better representation of the business perspective. Now here as well, both US GAAP and IFRS first of all allows, so that means there is a yes. Only when it enhances the representativeness of the information. Again, the same aspect that the real business aspect is being explained in a better format. That's the only condition which both US GAAP and IFRS have. Obviously, the two would have different legal language, but the spirit of that is similar. IFRS says that the change, whenever it happens, should be retrospective. Now what you need to understand is there is no LIFO method in case of IFRS. So it could be FIFO to weighted average or weighted average to FIFO. In case of US GAAP, on the other hand, there is LIFO as well. So it might be LIFO to FIFO or vice versa, and in fact there is weighted average as well. So overall, if you look at it, there will be three-way movement. It could move from anywhere to anywhere. What you need to understand is that there is a special clause for last in first out. The special clauses, let's talk about the normal clause first. And the normal clause again is that, like IFRS, the change whenever has to happen has to be retrospective. But when the change is moving from any method towards LIFO, that means when we are going towards LIFO, does not matter from where we are coming, the change is going to be prospective. Now keep that in mind, that whenever your destination is LIFO, the change has to be prospective. Okay, and in that case there is no adjustment. A is equal to L plus C. There is no delta that needs to be done on the date of change of the method. The whatever value is appearing in the books right now will become the opening value as per the LIFO method. Let us understand this from the example and also put that in form of a figure. I don't want you to look at the figures first. I want you to look at this example, which is again the same example that I have been carrying forward. Simplicity's sake, I have taken everything as one unit. The first purchase of 30, second purchase of 35, the third one is at 37. The orange bar is year 1 and this is year 2. Now here, if a firm is following LIFO, last in first out, and he needs to change into FIFO, let's look at the inventory first. And I also want you to calculate the value of LIFO reserve at different point in times. Here, here, and here. LIFO reserve, as you are aware, is the difference between the inventory, so which is 0 here, plus 5 here, and plus 7 here. What I also need you to know is how much is the delta in each year. So the delta in the first year is same as cumulative amount, which is delta 5. In the second year has been delta 2 and the cumulative amount is 7. So like we talked about in the previous session, the total hidden profit so far by a LIFO firm is equal to 7, out of which $5 was hidden in first year and 2 was hidden in the second year. Okay, now coming back to these formulas, at any point in time, if I am given the figures for LIFO and I am given the values of LIFO reserve, obviously in the footnotes I can convert these figures into first in first out. How do I do that? Is the total value of 5, which is the delta point here, the cumulative point here, I'm sorry, needs to be added to the LIFO inventory to be able to get to the FIFO value. Obviously that's fairly commonsensical. No delta here, it has to be cumulative. Another aspect is I did not talk anything about taxes. There was absolutely no tax aspect here because this is impacting your COGS, which is a before tax figure. In the second year, if you look at it, the total LIFO balance is 7. The total inventory value is 30. So again, 30 plus 7 is giving me 37. So again, my first equation is holding true. What is more interesting to note is the second equation of conversion of COGS, wherein since COGS is during the year figure goes to the income statement or the P&L account, we need to make adjustment using the delta. So that's what an apple to apple is, that inventory is a balance sheet item, is a cumulative item. Therefore, we will not take anything delta, we will take the total cumulative balance on that day. However, on the other hand, that COGS is a delta figure, goes into the P&L, we will do that using my delta. Now delta in the second year, it's better to look at the second year. Delta in the second year is plus 2. So if I put here plus 2, negative, and COGS LIFO is coming out to be 37 here, I would get COGS FIFO to be equal to 35. So all I'm saying is that sometimes it appears whether the example is leading to the equation or the equations is leading to this example. Well, that's really not the point who is leading into the other. Both are very, very interrelated. It is extremely important for you to understand, this conversion, at every point in time. Let's look at conversion at T1. If you convert from LIFO to FIFO, what will happen? Obviously, the inventory is going to go up by $5. This is a retrospective amendment that we are doing. We are moving from LIFO to FIFO. So under IFRS, so in any case, everything is retrospective, and under US GAAP as well, it is retrospective unless the movement is towards LIFO. Okay, so let's just move from L to F. Again, do the retrospective. Inventory goes up by 5, which is here. The other aspect is COGS for a LIFO firm would have been higher. So when you convert it to FIFO, my COGS becomes lower by 5. As a result of which, my gross profit goes up by 5. Ceteris paribus, my profit before tax goes up by 5. Ceteris paribus, assuming a tax rate of 30%, my tax payment would have been higher, and therefore my net impact on profit after tax is 3.5. So overall, if I look at it, my P&L account goes up by 3.5. I wouldn't have paid that tax because in the first year I must be following LIFO. So therefore, I need to pay that tax now. Outstanding tax is 1.5. So if I were to summarize this, I can write this as increase the inventory by LIFO reserve value, increase the taxes by LIFO reserve into tax percentage, and increase the P&L by LIFO reserve into 1 minus tax percentage. It's fairly simple to understand. I want you to draw this using the figures of second year now. Now in case of second year, you would have to assume that the change did not happen in the first year, and cumulatively you are making a change for both these years put together. So this is like a change happening at T2. Now the inventory here would go up by 7 because that's the cumulative change of both the years. In the second year also, my COGS, now the blue figures that I'm writing is for the second year, my COGS would have been lower by 2. My gross profit would be higher by 2. Overall, tax would be more by 0.6, and therefore my PAT would be more by 1.4. So if I put together both the PATs of the year, my PAT would be cumulative PAT, what I called as retained earnings or reserves and surplus, would be higher by 4.9, and the cumulative tax payment would have to be made now, which is 2.1. What you need to understand is at the end of the second year, you will have to make a cumulative adjustment of both the years put together. Obviously, that's what a retrospective impact means, that you would have to go back to the history and come back restating all the accounts as if the new method, which is FIFO, was being followed since beginning. So that's what I'm doing. So if since at the beginning I would have been following the FIFO method, I would have to pay 2.1 of extra tax, which I would pay now. My retained earnings cumulatively would have been higher by 3.5 in the first year and 1.4 in the second year. Cumulatively by T2, they would be higher by 4.9. Okay, so this is like an important aspect of conversion from LIFO to FIFO. Had this been from FIFO to LIFO, I would not have passed any of this, because conversion from FIFO to LIFO, first of all, cannot happen in IFRS. LIFO is not allowed there. And if in US GAAP, like we talked about, that whenever LIFO is the destination method, then it is prospective, and whatever is the opening value will become the new cost as per LIFO. So it is always going to be prospective. No A is equal to L plus C need to be done at the time of conversion itself. Okay, now moving on to the last and the analytical slide here. The relationship of LIFO reserve, which was at T1 equal to 5 and at T2 equal to 7, and this delta in the second year, delta 2 was equal to $2, delta first was equal to $5. So that's how my LIFO reserve in blue was moving, and the delta in red was, the change in the LIFO reserve. Now the question is, there are two perspectives on which I am measuring my 4 parameters. If I am given the value of LIFO reserve, would I take it before tax or after tax? And the other aspect is, would I take the delta or the cumulative aspect of it while converting one inventory into the other, as in my LIFO parameters into FIFO parameters. If I have to convert the inventory, I will take inventory as before tax and take the cumulative value of the LIFO reserve. That's what I have done. If you look at it, I have taken inventory at entire 7, which is the cumulative value, and I haven't taken it 1 minus T. But on the other hand, if you look at the retained earnings here, I have taken cumulative value of 7 and have made it 1 minus T. 7 into 70%, 70% as in 1 minus 30%, 1 minus tax is coming out to be 4.9. So I can fill in this table by writing that although I'm going to take cumulative entire 7 here, but I'm going to make that 1 minus T. That means this is after tax. Obviously, because equity belongs to the equity shareholders, and equity shareholders get the value only after payment of taxes. So as a general rule that I would conclude later upon, that anything which will be given to the equity shareholder will have to be after tax. So that's here, the next point comes into the profit after tax. I'm going to take it 1 minus T again as an after tax level. But what you need to understand is the difference between the two is PAT is for respective years. So therefore, rather than taking cumulative value, I'm going to take these deltas of 2 and 5. If you want to look at that example, there is a delta change of 3.5 and 1.4. 3.5 and 1.4 from these perspective, 5 into 70% and 2 into 70%. 3.5 and 1.4. Okay, so any change in profit after tax between the two firms has to be 1 minus T and has to be taken using the delta LIFO reserve. And the last but not the least, fairly simple to understand, that you are not going to do 1 minus T, because now what you're looking at is profit before tax. This is not from, that is before tax, which is also equal to the change in EBIT, which is also equal to the change in gross profit. It is going to be before tax because we haven't reached the stage at which the tax payment is being done. And again, since it's a delta figure, I would take it at delta amount. So this is like a very, very important table which can be used to convert a LIFO parameter into FIFO parameter on the two fronts, which is whether you got to take it before tax, after tax, or you got to take it delta or cumulative. Okay, so I hope the small session on conversion of the method was helpful. I look forward to speak to you in my forthcoming tutorials. Till then, should you have any query, post that at query@finstudyclub.com. Thank you.